Hello, my friends. Today is May 7th, and this is my May FOMC Debrief. Now, before we get into what happened today, let's level set a little bit. So between the March meeting and today, we had a couple of developments. First off, of course, looking at the data front, we had first quarter GDP that came in negative. But of course, that was largely due to massive imports. If you look at the underlying, the GDP data was pretty good. But of course, between first quarter and today, we have Liberation Day. And since then, everything is changing and no one really knows what will happen. Now, on the labor market front, labor market continues to be fine. Non-farm payrolls was solid. But overall, though, the labor market is clearly cooling. You can see that in the average wages slowing down, average wage growth declining, decelerating, and of course, looking at various other measures such as JOLTS, job availabilities, you could definitely have a cooler labor market. On the Fed front, we have the Fed basically divided into two camps. I think the majority camp, led by Chair Powell, is one that advocates caution. So we have this big change in how the world operates, Liberation Day, and if you have tariffs, so again, that's a negative supply shock. It could mean higher inflation, but it necessarily means lower growth. So if you are a Fed that has a mandate, again, stable prices, full employment, what are you supposed to do? Now, Chair Powell was of the mind that we just got to stand, wait, and see what the data says, and then react, because he feels that he feels that it's pretty uncertain how the data will evolve. And he also points to inflation expectations potentially becoming unanchored. As we know, if you look at some surveys of consumer inflation expectations, like the ones provided by the University of Michigan, some people are really freaked out about tariffs, and their inflation expectations for the coming year have really skyrocketed. So if you're a central bank, then you are afraid that inflation expectations could be de-anchored because you think that if that happens, then you might lose control of inflation. So that advocates for caution. Now, another part of the FOMC, led by Governor Waller, and I'm not sure if there are other people beside him, I imagine there are, is that tariffs, yes, could potentially increase the inflation, but that increase will be transitory. What does he mean by that? So let's say that we have tariffs, 10% on all imported goods. That means if something, okay, just rough assumption, if something was priced $100, maybe it's a little bit more. Maybe there's full pass-through to the consumers, and so consumers now pay $110. Okay, but then next year, of course, we're not having an additional 10% tariff on top of that, right? So next year, maybe we go back to 2% inflation, so that $110 item, maybe it becomes $112, $103, $113, or something like that. So it's a jump in the level of the prices, but not a change, not a sustainable change in the rate of change, which is, of course, inflation. So from his perspective, tariffs, if there is an inflationary impact, it will be transitory. And according to standard central banking playbook, in transitory price levels, you just look through it. And so he wouldn't do anything. But if the unemployment rate rose, he would be eager to cut rates because he's more concerned about that. So that's where we were heading into the FOMC meeting. The market was not pricing in any possibility, okay, very small possibility of any movements on the policy rate, and market was pricing in a reasonable probability that we could have cuts, let's say 25% probability of we could have cuts in June. Okay, so no one was expecting anything. Now, at the meeting, Chair Powell was basically asked the same question over and over again. That is to say, why don't you cut rates? Why don't you cut rates? We have all this sentiment data that's saying that everyone is sad, everyone is feeling uneasy about the future. Look at all those container shipping data from China. It's obvious that the economy is slowing down. And to this, Powell would reply this.
People are feeling stress and concern, but unemployment hasn't gone up. Job creation is fine. Wages are in good shape. People are not layoffs, or people are not getting laid off at high levels. Initial claims for unemployment are not increasing, in any kind of impressive way. So the economy itself is still, in solid shape.
Basically, he understands that the sentiment data from surveys has been pretty downbeat. However, from his perspective, the hard data is good, solid. So, all these people complaining in surveys and on TV about the economy, you just don't really see that in the data yet. And he wants to see that in the data before he acts. Now, if he does this, though, of course, he's going to be committed to being late because, when something shows up in the data, it's kind of likely too late to do anything about it, right? So usually, sometimes central banks would like to act preemptively. So let's say that they think a slowdown is coming, might want to adjust, but Powell was not doing this right now. And the reason he's not doing this is that he is afraid of stagflation. So in his remarks, he notes that we have all these different policy changes on the horizon: immigration, trade, he added fiscal this time, and also regulatory changes. So all these changes, some of them are inflationary, some of them are negative growth, and so forth. Now, the potential outcomes of all this are really, really wide. We could have a world where we could have, a big inflationary shock. We could have a world where we could have very negative growth, so a jump in unemployment. He just doesn't really know what world we will be. And from his perspective, there is the potential, as he says.
The risks to higher inflation and higher unemployment have both gone up, as we noted in our statement, and we've got to monitor both of those. We actually have a potential situation where there may be a trade-off or tension between the two, potentially. We don't have it yet, and we may not have it, but that's what we have, and that's why I think it's a very different situation.
That we could be in a world where we would have high inflation and high unemployment. So basically a stagflationary world where they will have to make very difficult trade-offs, whether to hike rates to get inflation down or to lower rates to get unemployment rate down. Again, when you hike, there's a trade-off there. Let's say you hiked rates to get inflation down, you would make unemployment worse in theory. And if you lowered rates to lower the unemployment rate, you can make inflation higher in theory. So he's afraid that the central bank will be in a position where they have to make trade-offs, so he's hesitant to act. So he's very much, basically, even though he's been asked this many times, just kind of sitting there and waiting, seeing the hard data. So it looks like he's committing to being late, and he's just not sure what to do. So it looks like we're not really going to get anything from the Fed until we see some big cracks show up in the labor market. Now, we didn't get that this month. It's possible we could have more cracks next month, or even a month, or even in a couple months, because we do see unemployment rate, the labor market showing some cracks. You see that in the unemployment claims, continuing claims elevated a little bit. You also see anecdotally that there are a lot of companies laying off workers. So for the moment, the Fed is going to be out of the picture. It's all about the White House. So I would say ignore the Fed for now and just focus on what the president is saying. All right, so that's all I prepared, and I'll be back on Saturday.